Do you dream about how you can make your money work for you and build a steady stream of income without lifting a finger? What if we told you that you could stop working, travel the world, eat well, and engage in your favorite hobbies, all while still making money? Having your money make money for you is one of the central concepts of dividend investing. So let's talk a little bit about what it is, what you look for, and why it might be the perfect strategy for you. What is dividend investing? Dividend investing is a strategy where investors buy stocks of companies that pay dividend. A dividend is a portion of a company's earnings that is distributed to its shareholders. It's like getting a bonus every time the company makes a profit. When you invest in dividend stocks and funds, you're essentially betting on the companies that pay regular dividends to their shareholders. These companies are usually well-established, profitable, and have a strong track record of financial stability. The goal of dividend investing is to earn a regular stream of income from these stocks and funds, which can provide a reliable source of passive income over time. But it isn't just about earning income, it's also about investing in companies that have long-term growth potential. By choosing companies that are financially stable and have a history of paying dividends, you're more likely to see your investments grow in value over time. So, how do you start dividend investing? Step 1, do your research. The first step in dividend investing is to research and analyze dividend stocks. There are many ways to do this, but the most common method is to look at the company's financial statements, earning reports, and dividend-paying history. Some companies are even part of smaller select groups that may make them more attractive. Dividend aristocrats are companies that are part of the S&P 500 and have been increasing their dividends for over 25 consecutive years or more. As of 2023, companies like McDonald's, Clorox, and Chevron fall into this list. And then there are dividend kings. They don't have to be a part of the S&P 500, though some are, but the only way a company can get this classification is if they've raised their dividends for at least 50 consecutive years. Walmart, Coca-Cola, and Johnson & Johnson are a part of this list. A company that consistently increases its dividends is a good sign that it's financially healthy and has a solid business model. By understanding these factors and implementing a disciplined investment approach, you can build a successful passive income stream. So, what are some concepts you should look into while you research? Let's look at a few. 1. Dividend yield. Dividend yield is a way to measure how much money you can expect to make from an investment. It's the percentage of the stock price that the company pays out in dividends annually. Let's suppose a company's stock is trading at $100 and they pay out dividends at $4 a share. Well, then their dividend yield is 4%. Generally speaking, a yield between 2 and 5% is considered pretty strong. 2. Dividend payout ratio. This is a way to measure how much of a company's earnings are being paid out to shareholders in the form of dividends. Why does this matter? Well, a higher payout ratio could be good news to an investor who is looking for steady income, but it may also suggest that the company is not reinvesting enough of its profits back into its business to support future growth. A payout ratio between 30 and 50% is generally considered healthy. 3. Dividend growth rate. The dividend growth rate is how much a company's dividends have increased over time. This figure is an important indicator of a company's financial health and its ability to sustain its dividend payments in the future. 4. Tax implications. Dividend income is generally taxable. When you're first starting out, most people don't consider this part because they don't yet have enough money to pay any meaningful taxes on. But be sure to consult with a professional to understand the tax implications of your dividends. 5. Risks. As with any investment strategy, dividend investment comes with risks. Market volatility, company performance, and changes in interest rates can all impact the value of your investments. It's important to diversify your portfolio and maintain a long-term investment perspective to mitigate these risks. Step 2. Choose a brokerage account. Once you've done your research and identified the dividend stocks you want to invest in, you'll need to choose a brokerage account. A brokerage account is like a bank account for investing. It allows you to buy and sell stocks, bonds, and other investment types. There are many brokerage firms to choose from, like Vanguard, Fidelity, Robinhood, TD Ameritrade, and M1. Look for a brokerage account with low fees and a user-friendly interface. If you already have a 401k through your company, it may make sense to use the same brokerage they use, if only to keep everything in one location. Step 3. Buy dividend stocks or funds. Now that you've done your research and chosen a brokerage account, it's time to buy your dividend investments. You can buy stocks individually or invest in a dividend fund that holds a portfolio of dividend-paying entities. When buying dividend stocks, keep in mind that you're investing for the long term. Look for companies with a track record of paying dividends and increasing them over time. It's also important to diversify your portfolio to minimize risk. This means investing in different sectors and industries such as technology, healthcare, and energy. Step 4. Reinvest dividends. One of the most powerful aspects of dividend investing is the ability to reinvest your dividends. When you reinvest your dividends, you use the dividend income to buy more shares of the stock, which in turn generates more income. This is where DRIPs may come in. DRIP stands for Dividend Reinvestment Plan, and it's a way to automatically reinvest your dividends back into the company's stock instead of receiving them as cash payouts. Here's how it works. When you sign up for a DRIP program, any dividends that you receive from the company's stock are automatically reinvested into additional shares of the same stock. This means that over time, your investment will grow as you accumulate more and more shares of the stock. It's a popular strategy because it allows you to benefit from the power of compounding. By reinvesting your dividends, you're able to buy more shares of the stock at regular intervals, which can lead to exponential growth over time. Step 5. Monitor your portfolio. The final step in building a passive income stream with dividend investing is to monitor your portfolio. This means keeping track of your investments and regularly reviewing your portfolio to ensure it aligns with your investment goals. Keep an eye on the companies you've invested in and any changes in their financial health or dividend policy. If a company's financial situation deteriorates or it stops paying dividends, you may need to consider selling your shares and reinvesting in another dividend-paying company. Common mistakes. It can be exciting to make the decision that you want to invest in dividend stocks and you're ready to make a ton of money right now. But be careful. Dividend investing is a long-term strategy, but many people fall victim to wanting a shortcut and making a lot of money right now. So let's look at a few mistakes you should avoid. Mistake 1. Chasing high yield. It's tempting to invest in stocks with high dividend yields, but this can be a mistake, so don't get too excited. A company with a high dividend yield may not necessarily be a good investment if its financials are weak or if it's paying out too much of its earnings as dividends. Instead, look for companies with a history of consistent and increasing dividends. Mistake 2. Failing to diversify. Don't put all your eggs in one basket. Diversification is key to reducing risk in your portfolio. Investing all your money in one or a few dividend stocks or funds can be risky. You should diversify your investments across different sectors and asset classes to reduce your risk exposure. Mistake 3. Chasing after short-term gains. Dividend investing is a long-term strategy. Don't get caught up in short-term gains and losses. Focus on building a high-quality portfolio, diversifying, and reinvesting your dividends. Mistake 4. Not monitoring investments. Don't forget to keep an eye on your investments. Once you've invested in dividend stocks or funds, it's important to monitor them regularly and stay informed about any changes in the company's financials, dividend policy, or market conditions. Mistake 5. Acting on emotion. Don't let your emotions drive your investment decisions. Making rash decisions based on short-term market fluctuations or emotional reactions can be detrimental. Stay disciplined and stick to your long-term investment strategy to achieve your financial goals. Investing in the stock market always involves risk, and dividend payments are not guaranteed. You should carefully consider your investment objectives, risk tolerance, and financial situation before making any investment decisions. So it's always a good idea to consult with a financial advisor or investment professional to discuss your options and ensure you're making the right decisions for your individual circumstances. That being said, dividend investing can be a powerful strategy for building a passive income stream. By investing in high-quality, dividend-paying stocks and reinvesting your dividends, you can grow your wealth and achieve financial freedom over time. That's it for this video. We hope you learned something new today. Do you invest, or would you consider investing in dividend-paying stocks or funds? Tell us below, we'd love to hear. If you enjoyed the video, please share it with a friend, like, subscribe, and hit that bell icon so you don't miss out on new content. See you in the next one.